Hey Kshitij, good evening. Can you hear me?
Yes, good evening, Yash. Hello, everyone. How are you? Good time to have a chat on markets, I guess. Markets at record highs. Sensex top 63, Nifty above 18,700. So, yeah, it's a good time to talk about markets and where is it headed.
Yeah, absolutely. We're scaling new highs almost every single day, up for a seventh straight day today for both the Nifty and Sensex. So
Absolutely, and I was just I was just looking at the data, and we found that the last time when we were up 7 days on a trot was back in October, and so far in 2022 there hasn't been any other instance where market sort of rallied for more than 7 days. So yeah, tomorrow could be a litmus test. Let's see, if the history repeats, and tomorrow we might have a red day or a profit booking day.
yeah, let's see about that. And while uh, Sandeep joins us, I'll just quickly run through all of today's action in the interest of all those who have joined us and not to leave the spaces hanging. So yeah, I mean, like I said, we had like the seventh straight day of gains for both Nifty and Sensex. Mid caps and small caps were also up. Mid caps up 1.1%, and the small cap index was up 0.5% odd. So, nearly two stocks gaining for every one loser. So, even the market breadth was quite positive. Metals and energy stocks were top of the charts, up 1.8% each, and autos and real estate also seeing healthy gains. We saw some bit of profit booking in the PSU banks, which have been roaring all through the past 6 months. So that's that little bit of information. Okay, so Sandeep is in. Sandeep, can you quickly unmute yourself and give us a mic check?
Yeah, it's working now, I think.
All right. There is a little bit of a disturbance, but I hope it gets sorted.
Yeah, there's some background noise. I don't know what.
Yeah, I mean, even I'm not able to hear your voice clearly. I guess that's some issue with Twitter Spaces itself. Um,
Let me reconnect again.
yeah, all right. And in the meantime, while Sandeep joins, I'll just quickly talk about Stockwits, guys. So Stockwits basically is the original social media platform for investors and traders. Our mission is to empower retail investors to become sharper and become the platform that hosts global conversations across asset classes, stocks, cryptos, NFTs, different trading styles, and experience levels. We recently raised about $13 million in our Series B fundraise, and TimesBridge, which is the VC arm of Times Group, is our partner in our vision for the Indian markets. Uh, as you guys all know, Sandeep is the guest speaker for today's session. Sandeep has been in the markets for over 25 years. He started off his journey with SBI Mutual Fund, where he worked for the first 11 years, and then held key positions at JM Financial and Prabhudas Leeladhar as well. Quite frequent on business news channels, and is a very well renowned market voice, someone to go to at times like these. Sandeep, thank you so much for joining and agreeing to do this. All right. Sandeep, let's start off the conversation. We've seen almost a one-way rally in Nifty since the low of 15,200 back in June. Of course, we haven't seen a similar kind of a participation from the broader markets, but the general sentiment remains positive. What do you make of the market setup right now? Sandeep, you're on mute.
Yeah, so Indian markets have benefited because of a few factors, and which are to do both external as well as internal. So the external factors have been that the inflation issues, the impact of the Russian crisis on overall growth dynamics, as well as the fact that food and other inflation in other parts of the world has been much higher than that in India this time. Now, historically, what we used to see was that in India, inflationary trends used to be worse than the global trends whenever there was an inflationary spiral. This time it's been opposite. That's one factor. The second factor has been that there's been a big issue of growth as well as sort of a economic crisis brewing in China. And since that market has not been doing well, it's one of the biggest uh, economies of the world. And we actually saw that a few weeks back, the Chinese, Hong Kong markets, etc., went to as low as 20-year lows. So a lot of the money flow has happened into India. And thirdly, the phenomena of domestic investors investing into equities in a big way is a phenomenon which all of us know. So there have been flows directly, there have been flows, huge flows through mutual funds and also through insurance companies, etc., which has supported the Indian markets. And in terms of overall growth, also Indian economy is done reasonably well. So not as buoyant as what it could be, but it's held up reasonably well. So I think there are a lot of factors which have contributed to this. And as a result, see now the Indian markets are at a almost historic premium to emerging markets. And the correlation of Indian markets with most global markets actually broke down this year, which is actually a 5% probability. Yeah, historically, like it never happens that we are completely uncorrelated.
Mhm. Okay. So, like you mentioned, a trifecta of reasons being helping our markets move up. Inflation worries are also, easing off. Oil prices have cooled off sharply, and FIIs are sort of back meaningfully, you can say, after we saw almost 9 to 10 months of persistent selling by them, which started from October last year. On the face of it, things do seem to be, almost picture perfect. Are we missing anything? Are the markets ignoring any risks over here, or could we, continue this rally on and go on to hit far greater heights?
No, see, I think we need to be clear that today market valuations are at a historic premium to global markets, as well as almost a 20 to 23% premium to the valuation in which Indian markets have traded historically. Secondly, there is a monetary tightening phenomena which is on. In India itself, rates are up almost 2% over the last 6 months, and globally also rates are moving up. They'll move up further. And what, in my view, markets are ignoring is that rates will not only move higher, they'll stay higher for a long time till inflation comes back into reasonable zone. As well as because in Europe, you see inflation is running above 10%. In US, it's between 7.5 to 8% now. Their target in
Right.
inflation is 2%. So they to move there, they need to keep rates higher long for longer, and that is something I think markets are underestimating. So 2023 might not be as smooth as what people think that Fed will stop hiking and then they'll start cutting immediately. That's not going to happen.
Okay. So with that context, Sandeep, what is it that you're advising your clients? Are you asking them to book profits, given that we are at all-time highs, or you're adding on to your positions in certain stocks?
See, the market is very rotational. Indian market is a big market now, and
Mhm.
opportunities keep on coming. And from my perspective, like we don't invest in too many stocks. So I think for people who don't invest in too many stocks, who just want to invest in a few stocks, opportunity is always there. Unless and until we are in a severe economic downturn when everything falls. So we are not likely to reach that stage of in economic growth cycle. So opportunities will be there, but people need to realize that very highly valued stocks, etc. I think that's where valuation compression could happen, and that those are very overowned. So typically, when stocks become overowned, over fancied, or stock sectors become overowned and over fancied, that's where the risk comes in.
Got it. Shadid?
Right. Good evening, Sandeep. And wanted to take up your view on the small and mid cap space. In fact, we've hit record highs in terms of benchmark indices, be it Sensex and Nifty, but I think broader market has still, there's still some space to catch up. So, what is your view on the broader market space for the year 2023?
So I think there are huge opportunities in the broader markets, but overall broader market valuations are still very high. So, like I said to the previous question, what we are likely to see is that some of the very fancied stocks, very fancied sectors where growth expectations are much beyond what valuation can sustain. I think that's where the risk is still there. So small mid caps might not have gone to all time highs, but then they moved up very fast earlier, right? So it's not that they are very cheap. So the overall
Hmm.
small and mid cap space is not cheap. So I think people need to be careful where they're investing.
Right. In fact, interesting point there, Sandeep. I'm sure our listeners would take note of that. That at this point in time, the broader market space, the valuation of the broader market still is still not at a level which is cheap at this point in time. Now, there's also too much talk on various media channels on tickering of the capital gains tax in the upcoming budget. I read your tweet as well on that. So, do you also see a change? What are your views on that?
Yeah, I think in my view, this is the last budget prior to the general elections of 24. So I don't think anything will be done which will spoil investor sentiment. So I think all these rumors and all which are going on, in any case, no one knows what's going to happen in the budget. So I think it's better not to speculate.
So no expectations from your side. Any other expectation which you think that could be in the offing, something which could be in the interest of investors and traders?
See, I think when corporate rate cut was announced a few years back,
Mm-hmm.
the government had announced that on at the 75th anniversary of India's independence, etc.
Right.
Subsequent to that, there will be action on personal income tax rates also.
Mm-hmm.
So I am hopeful that the government will act on that, and prior to the elections of 24, it makes sense for them also, and we will see some cuts in personal income tax rates. If that happens, then we could see the overall consumption space do very well.
Right. In fact, we also keep our fingers crossed, and if in case we do see cut or a slight tinkering with the personal income tax rate. So on that note, over to you, Yash.
Thanks for that, Kshitij. Sandeep, capex and domestic manufacturing is a theme that a lot of experts are really very bullish on. There was a report a few weeks back that Tata's aim to make iPhones, and almost 25% of all iPhones would be produced in India by 2030. What is your view on the overall sector? Where is it that you see the most value?
I think so. One is a revival of corporate capital expenditure. So that's happening after a very, very long time, and that's a real cycle. So companies across the board are investing, be it companies catering to the consumption sectors, companies entering new sectors, or companies catering to China plus one policy, to the China plus one kind of demand, or those related to those related to the infrastructure sector capital expenditure. For example, in a lot of investments and indigenization happening on defense, on railways is on a big investment cycle. So I think that this
Right.
theme will play out over the next few years. But what normally happens is that stocks run up very fast and then they also consolidate and correct. So people need to just be careful that they are not buying stocks which have just doubled or tripled in a few months, and then those stocks fall 30-40%. So I think if at so people should wait for opportunities. Markets always give opportunities, and look at buying into these sectors.
Got it. Sandeep, rising interest rates, cleanest and perhaps the strongest balance sheets in nearly decades. FIIs are buying. Obviously, we know they're overweight on the banking and financial names. How are you playing this team, considering its weightage and how vast the sector is as well?
Yeah, so we've seen a big run already in financial. So we need to see how that moves because as of now, people are only considering the positives of improved credit cycle. No one is considering the impact of higher rates on possible increase in delinquency. So that's something we need to watch out for. That's always happened historically in India in the past. So if the banking sector has evolved so much, it won't happen this time. That's something I wouldn't bet on. That's one part. Secondly, people should bet on the larger private sector financial, like specifically banks, and because the big fodder for banks to make money is low cost deposits. So banks which are gaining market share in low cost deposits, they will do very well in a rising interest rate scenario and also a scenario in which credit growth has picked up. And smaller banks, although they have done well in the recent past, they could get into some sort of headwinds in terms of margin compression because the new generation savers or the younger population, etc., is not really inclined to put money in these kind of banks.
Got it. Kshitij, over to you.
Right. Thanks, Yash, on that. Sandeep, let me also, from markets, let's go to primary markets. So what is your view on the recent IPOs which have hit D Street a long time coming because we saw, sort of lull in September quarter, but then again now IPOs have sort of picked up, and now that we are at record highs, or we could say. At the highest point in terms of Sensex and Nifty. Do you see fundraising picking up in 2023? What are your views on that?
Yeah, so I think companies, managements, obviously, and merchant bankers want to take advantage of the opportunity of high markets, high valuation, and more investor interest to come and raise money. But from the investor standpoint, I think most of these issues are very, very highly valued. They come at valuations which are at significant premium to established companies, similar companies which are already listed. They move up initially sometimes because of illiquidity premium, but the valuations are very high. And most of these companies, if you see the IPOs, are offer for sale. They are not even primary fundraising. So old set of investors are trying to take advantage of higher markets and sell out to the institutions as well as retail investors. So I think people should be very careful. I don't think much money will be made in any of these IPOs. Like obviously there will be exceptions, but broadly, most all of them I've seen are very, very expensive.
Right. Well, a word of caution there from Sandeep. Now, Yash, you might have also asked about these sectors which one should be betting on. Let me also look at, or at least pick brains of Sandeep, any overheated sectors which investors should avoid or sort of pair positions in 2023.
So I think 23 externally linked sectors are something where we could see challenges. So we could see challenges for technology companies because Indian technology companies are no longer small companies which used to benefit when there were downturns. Now they are mainstream companies which cater to large technology requirements of large corporations all over the world. So any downturn will hit their growth. So I think that's where people should be careful of. That's one space. Secondly, in my view, the Chinese economy is going through a deep downturn, and this deep downturn is unlikely to be revived very soon because the entire uh, uh, the entire growth story over many years was built around excessive capital fixed asset investments, and a lot of those projects have become zombie projects or they are big stresses. So similar to what so we saw this sort of stress in India 12, 13 years back, and it took nearly 10 years for the entire mess to get cleared out. So China has to go through that cycle. So to that extent, we will see weakness in many commodity sectors, and to that extent, this entire theme of a commodity super cycle, etc., is something I don't believe in. I think we will see commodity prices subdued for a long time.
Right. So, in fact, a word of caution coming for commodity linked sectors as well as export linked sectors, which listeners should be wary of, especially in the year 2023. Over to you, Yash.
Thanks for that, Kshitij. Sandeep, new home registrations, they've shown almost no signs of slowing down despite the rising rates. Yet, most of these names haven't had that great of a year. What is it that's weighing on the real estate sector, and could we see a reversal in 2023?
See, what's essentially weighing is that these stocks ran up very fast initially. So if you see most of these real estate companies which have got a decent size, be it pan India real estate companies or region specific, many of them went up by 3 4 times in 2021. So so this year most of them have consolidated, and because some sort of margin compression has happened for them as the price increase in the real estate sector has been subdued, although volumes have gone up, and to that extent although sales have gone up, the kind of margin improvement which was expected has not really played out. But given the fact that the real estate sector went through a 10-year downturn, so it's very likely that we have at least a 5 6 years upturn. So I think there will be opportunities in this sector for sure.
Sandeep, you did mention that to avoid sectors which have run up very quickly and look for ideas where we are yet to see the sort of run up that you would expect. Makes sense perfectly. That would be a great strategy for 2023. Does that by any chance include these new age companies? Because a couple of reports I read recently from some foreign brokerages. Let's take the case of Paytm, for example, where CLSA said that it's worth looking at. What are your thoughts on it? Does any of these new age companies interest you at these levels?
Yeah, so all stocks are worth looking at, but not necessarily buying them. So I think that's what I'll say. So I think among the new age companies, I've always maintained that uh, essentially Zomato and Paytm have business models which can make money, and they have some moats to play with. The
Mhm.
rest of them don't really have that. So I think these are the two stocks I'll look at buying at some stage, but I'm not sure when.
So it's still not yet there.
No, no.
Okay, got it. Kshitij, over to you.
Yeah, right. Well, on that note, Sandeep, let me also go on to some lighter conversations. Now, any learnings for investors from the year 2022, which could actually come in handy next year as well?
Mm, So I think it's just that people expect that what did well in a particular year will be the sector or theme which will do well in the next year also. But that normally doesn't happen. For example, I see a lot of investor portfolios which get sent to me. They are full of a lot of technology and commodity companies which have actually done very badly this year. Don't we should not think that what has done well in the recent past will do well in the future. So I think we need to continuously evaluate where valuations are reasonable relative to growth, and if required, shift our investments accordingly.
In fact, a valid point there, Sandeep. Now, last question for me: any stock which you're still holding for more than 5 years, or you could, if you can't name the stock, you can say the sector.
Yeah, many of them. So I think in consumers sectors, there are companies which we have held for a long time, and then so I think it's largely uh, consumer stocks broadly which we can actually hold for long term, because that's where they keep on growing. Rest of the sectors, taking a view more than 5 years, it's good to talk of views of very long term, but then stocks and sectors become overheated, so we need to shift because see, it depends on how you invest. So because I just invest in 8, 10 stocks, so I have to shift when I see opportunities because I don't keep on adding stocks to make it a 50, 100, 200 stock portfolio. So
Hmm.
for people who have a different strategy where they just keep on buying without selling something, so for them the strategy could be different.
Right. Any portfolio asset allocation advice for investors now that equity is at you could say in a overheated space? So should one sort of tweak the proportion of asset allocation as well? Does that make sense?
Yeah, so it depends on how much people have already allocated, the age of the investor. So there are a lot of factors. It's tough to generalize, but I
Right.
think Jan to March 23, we'll see a rush for more deposit raising by banks, etc., because the deposit growth is lagging behind credit growth so much
Hmm.
that beyond a point of time they cannot hold deposit rate lower. So I think that time people who would like to diversify away from risky assets to potentially risk-free assets, opportunities could come.
Right. Over to you, Yash.
Um, Sandeep, I would like your thoughts on the Adani Group stocks because, irrespective of market conditions, they continue to climb higher. Again, there's hardly any analyst coverage. Have you, by any chance, track any of them, or do you have a view on Adani Group stocks?
No, I don't because it's tough to buy companies where you don't know why they go up or go down.
All right. So let's move from the Adani Group stocks onto a sector which has sort of been the darling of Dalal Street for several years, chemical stocks. Recently, we've seen, a lot of margin pressure, related issues bothering these stocks. So far, the Q2 and the Q1 results have been slightly positive. What is your take on the space now? Do you think that raw material pressures are behind us and we could see margins improve from here? And what would be your pecking order from the space?
No, I think people should be very, very careful of chemical stocks going forward because these companies used to operate at a particular operating margin because of COVID related sort of disruptions in supply as well as issues that China faced, their margins went up to levels which were unsustainable levels. Finally, all of them are commodity companies. We need to realize that you'd say specialty chemical anything. Finally, these are commodity companies which will have X amount of margin. My
Right.
view is that going forward, given the kind of huge capex many of these companies are doing, as combined with slowdown in China, which is not only the largest producer but also the largest consumer of many of these chemicals, we will see the margins go back to near, or maybe they could be slightly higher, or but near to what their margin used to be earlier. So this phenomena of higher margin should not be extrapolated, and chemical companies cannot trade at 50, 70 PE ratios. These are at most they can trade at 10, 12 PE ratios. So I think then valuations are still completely distorted, and we could see further significant downside in across the board.
Got it. There was a major news yesterday evening in the aviation space that Air India is going to merge with Vistara, and there's all sorts of jokes doing the round on social media. It's like merging Ambassador with Tesla and all those kinds of jokes. Is it advantage Indigo from here?
No, actually, so what happens is that with if once this merger is through, we effectively have only one full service airline in India. And I think the reason they are doing the merger the reverse way is because Air India is the one who has got all these routes globally, rights, parking bays, all those slots and everything are with Air India. So the reverse merger in any case was not possible. So they are doing it now. Vistara got established as a strong service airline. Whether they can take those service levels to Air India is something we need to see. It's going to be tough. But Indigo, I think Interglobe Aviation is in a good space and they'll do well because the other companies like SpiceJet, Go Air have financial issues of their own. So I think Interglobe Aviation will be able to hold their market share. So obviously, when Air India becomes much more serious, they'll obviously lose some market share, but then that's fine.
Got it. And it's also the year-end time. There'll be very soon vacation and people will be traveling again. Uh, are you constructive on the travel and hospitality sector? And any stock ideas that you'd like to share?
So hospitality overall, travel related companies, I'm quite positive, and we have been holding on to companies like Lemon Tree, Indian Hotels, etc. for a very long time, like from much lower levels. So, and I continue to hold them because I think next 3 to 5 years are a very strong period for hotels because supply will lag behind demand.
A lesser known name from the space which has actually been doing very well is Easy Trip Planners. There's been a bunch of corporate action over there. There's a stock split, then a bonus as well. Still, the stock continues to do well. Any reason why? Sandeep, have you looked at the company?
No, no, no. Like I've looked at it, but I don't know why it's going up.
All right, Kshitij.
Right. In fact, from the sectoral space, we've touched on the overheated sectors. Any value buys which you think, or sectors which could grab attention in the probably next 6 to 12 months?
So I think it's like I don't really want to talk about too many idea like for specific
No,
themes, but I
sectors,
think,
sectors. Huh. In
but
terms of
broadly, I think we will see that there are opportunities in autos, auto ancillary. There are opportunities in the defense related companies, some companies which are or companies catering to the kind of capex cycle which railways is planning, etc. So I think a lot
Mhm.
of these companies and a lot of uh, construction, etc. Companies which are not very leveraged and which have got totally ignored in the previous cycle. So as interest rates peak out, we could see those companies also start to perform.
Right. No, in fact, today we saw the GDP data coming out, and the GDP rate has actually slowed down to 6.3%. Could that be the turning point where we could see some bit of profit booking probably tomorrow?
I have no idea what will happen tomorrow.
No. In terms of that trigger moment, we could say that could lead to some bit of sell off on the street. Otherwise, because D Street has been taking all the bad news very gracefully and heading to record highs. But anyways, your view on the GDP rate which has come out and how it would sort of impact the markets in the near to medium term.
So I think the GDP growth is fine. So I think it's in line with broader estimates, and I think Indian GDP will remain. I don't see any issues per se with the overall GDP growth. It's just that the external trade issues will be there. But given the fact that the this time the cropping cycle also is good and crop price also higher, so I think there could be some rural demand uptake also going forward. So I don't think per se growth is such a issue. Like we could argue that why are we not growing at 8%? Why are we growing at 6%? But then
Hmm.
there's a global context to it, and so we cannot stand alone continue to grow so rapidly when the entire world might actually be in a recessionary cycle next year.
Right. Now, also let me also understand from you, Sandeep. I'm not too sure whether you're tracking how well placed are with the investments made in other developed uh, markets, or you could say a US or the UK. Now that India is the first one in terms of pairs to hit fresh record highs. Now, will does it make sense for us to sort of diversify, Indian investors to diversify into other geographies, because then these markets might be catching up now?
Yeah, so I think the large US corporations which trade at cheap valuations, investors should definitely buy them whenever they fall to low valuation, like a low double digit kind of valuation. Any of these
Hmm.
companies, whenever they fall to, people should buy them, but stick to the larger ones. So, and but outside of the US companies, wherever people have tried to buy,
Hmm.
they have
Hmm.
burned their hands. So I think well, it's tough to track those companies so well. So I think these investments through fund of funds into China, etc., people have lost a lot of money. So they might move up going forward, but it's tough to know what those companies will do. There are government intervention issues, so you never know what's going to happen. So I think in free economy, overseas companies like some opportunities could come in Europe, large MNCs in Europe or US.
Hmm.
Yes.
Right. Over to you, Yash.
Sandeep, I have one last question, and then a couple of questions we got from our listeners in the comment section. So we'll address that. My question is on the power sector. We've been talking about how climate change is affecting everything, and renewable energy has been one of the biggest focus for the governments worldwide. In fact, we're seeing large investments by some of the leading corporate houses in this space, and yet in a year like this we have a stock like Coal India up 55%. It's in the top 3 on the Nifty for year to date returns. What is it that's working for the stock or the space in particular?
I think discussing broad themes is good overall, but when we invest, we have to look at growth versus valuation and invest where we see value for the growth that a particular company is going to deliver. So we cannot go and buy any company at any valuation. So I think that's the paradigm with which investors should operate. And as long as they can do that, they'll do well. So Coal India became excessively cheap, and then their volume growth suddenly picked up, their production picked up at a time when prices were also higher, etc. So that helped them. So they are generating strong cash flows, paying out strong dividends. And this year, we also saw a revival in the overall PSU basket, right? So majority of PSUs have done well this year.
All right. Sandeep, Ashish Suman wants to know your view on the logistics sector.
See, logistics overall is a good theme, but then there are very less. There are not too many plays we can make in terms of the listed space to invest in. So there are a few, and some of them have done very well also. So I think the growth is there, but it's not a sector where there is no competition. So I think the competitive intensity is also very high.
All right. Debashish wants to know your thoughts on the sugar and rice sector. I believe
So
there was
sugar.
some news on in rice as well, like the government has withdrawn the exports ban. I think that is very recent.
Yeah, so rice prices moved up, so export ban was removed, and many of these rice companies have shot up also. So I think the challenge is to buy them when they are in a downturn. When they already doubled or tripled, it makes no sense to buy them. Sugar overall, I think, could still do better because many of the stocks are quite off the highs, and the overall sugar season this year could be better in terms of productivity, etc. And last year we saw a significant increase in state advised price, especially in UP. So that might not happen this year. And plus the ethanol story is there for them also. So next couple of years could be good for that sector.
And any thoughts on the pharma space, considering that it is one of the underperformers this year? Could 2023 be the year for them?
So I think people think that pharma companies have not performed because they have gone a lot of retail investors invest in speculative and small pharma companies. But if you actually look at it, you see Cipla or Sun Pharma, these kind of companies have actually done very well. So it's not that they have not done well. So pharma, unlike many other sectors, is very very stock specific sector. So I think people need to be careful of where they are buying, look at the balance sheets of the companies, and see invest only in those companies where they see free cash flows coming.
All right. Um, on that note, I guess I'll wrap the conversation up, Kshitij, unless you have any questions.
No, no, right. Good from my side as well.
Awesome. Thank you so much, Sandeep, for agreeing to do this and for all the insights that you shared. Guys, for any of you who have tuned in late, do not worry. The Spaces session is being recorded and it will be the first pinned post on our Twitter handle. So you can go back and listen to Sandeep talk about his view on the markets and tons of stocks and sectors as well. And while you're there, do not forget to check out the Daily Rip newsletter and follow us if you aren't already.
All
All right,
right,
guys.
bye.
Thank you so much. Bye bye. Take care.
Thank you, Ash. Thank you, Sandeep.